Good morning. Happy Wednesday. Happy hump day. We're halfway through the week. Halloween's coming here in just a day or two. It's a really exciting time. We have a ton of stuff in the news, and you don't need me to tell you a ton of stuff in the news. Of course, job numbers are going to dominate the week. We have all sorts of interest rate news. Regarding the job numbers, it's going to be so confusing. We have the influence of the Boeing strike with 33,000 people out of work, most likely getting unemployment benefits. We have the folks from the two hurricanes out of work getting benefits. So it's really gonna distort the numbers, maybe as much as by 100,000 people, which may not only impact the amount of jobs created, but also the headline unemployment number. The person who I love to follow for employment numbers is Claudia Spahn. She has a great free newsletter called Stay at Home Mom. In that newsletter, and she's one of the preeminent, kind of labor economist, in my opinion. She came up with the Spahn rule, which people have incorrectly used this season because the Spahn rule was triggered last quarter. She immediately came out and said it's a false reading, and she had her reasons why the Spahn rule did not apply. In her most recent newsletter, she said that depending on what the reading is Friday, it'll be the first time in modern history that the Spahn rule did not trigger as it was intended or built. Very interesting newsletter. But she commented about who's worried about a bad jobs report reading because of those things I mentioned. And so who knows what will happen on Friday. I think generally speaking, the employment market's good, but there's going to be this distortion. And whatever it is, who knows how the bond market's going to react. And that's what my topic is today. My topic is not specific to recent news on drivers of what will affect interest rates. Instead, I wanted to share a recent article from Calculated Risk. The Calculated Risk newsletter, Bill McBride writes this newsletter, and I think it's daily. And sometimes it can come out twice a day. And I have I get the free subscription, which means I only get a quarter of his stuff probably, but it's still overwhelmingly great data, and you can glean a lot from it. It's so much it's hard to keep up with. I can't imagine what the paid subscription looks like. But in his newsletter from yesterday, titled Lawler, and it's mortgage rates have surged since the Federal Reserve cut interest rates last month. And he's trying to explain why that's happened. Now, everybody who's listening to this, I know, has already read plenty on this, heard plenty of commentary of how the Fed cut, short-term rates by 50 basis points, but since then we've seen long-term interest rates just skyrocket. And I would say as expected, but let's say unexpectedly. I also read today that we are now in, I think, our third quarter in a row where the the Treasury is selling off over 125 billion in treasuries. A ton of supply, just a ton of supply keeps flooding the market. But that's not, but I really like this newsletter, and it's Tom Lawler, who is a housing economist, and he's very well quoted, very well published. I tend to align with his point of view. And I, like many of you, or some of you, I'm a loan officer. I'm no economist. I'm no financial analyst. But what I do try to do is I do try to educate myself, and then I try to glom on to things that make sense. And so Tom Lawler makes sense to me. And here's what I want to share. And what he wants to share is just the nature of how mortgage rates are formed. Simple enough. And he does it in a very, very simple way to understand, a way that we can understand and adopt, and then bring into our lexicon, bring into our advice, and can have command of. And here's what it says. It's really simple. It's really, really simple. Here's how mortgage rates are created. It's the neutral rate plus the rate of inflation plus the normal spread between a 10-year treasury and a 30-year mortgage equals the interest rate. And so let's break that down. Really simple to understand. Now, the first question is, what is the new R, or neutral rate? And the neutral rate is where the Fed is neither accommodating or restrictive, right? It's just where there's just natural activity, right? And what's happened, the perceived neutral rate has been moving up. And it's now expected that the neutral rate is going to be between 1.75 and 2%. That is, the overnight cost of funds needs to be between 1.75 and 2% to not be accommodating or restrictive. Now, here's really what dictates that. You can think of it in a different way. What does the cost of money need to be to manage inflation to 2%? That's another way to think of it, right? Because what does the cost of money need to be to peg inflation at 2%? And so it's going up slightly. It's going to be 1 3/4 to 2%. That's what the discount rate needs to be, right? So let's say it's 2% for easy math. We start with 2%, and then to that we add inflation. And so if the Fed was to hit its target inflation, we got a 2% neutral rate plus 2% inflation. Now we're at 4%, right? Now 4%, that's on the short end of the curve. If you had the natural spread between 10-year Treasury and 30-year fix, right now that's running around 2 3/4, right? So if we take the 2% neutral rate, the 2% inflation, the 2 3/4 point spread, then mortgage rates should be at 6.75. Pretty easy to understand, right? I love the way that explains what you can expect interest rates to do. That makes a ton of sense. And so right now, right, inflation is higher than 2%, and so 30-year fixed rates are higher than 6.75%, right? And so super easy to understand. Now, what we don't have, the other thing we have to pay attention to is the 10-year Treasury is either flat or inverted. Historically, it's not inverted. When it uninverts, that will put more pressure upward on rates. But Tom Lawler goes, based on this simple formation of how mortgage rates are created, next year, rates should be between 6 and 7%. And what he says is that's the new normal, but that's the new normal using a classic view of how mortgage rates are formed. And I like that because it's really simple to understand. Neutral rate plus inflation plus the 10-year, 30-year mortgage spread equals mortgage rates. I love that. Now, there's all sorts of predictions about how rates are going to drop and the Fed's going to cut interest rates and all these things. And it's possible. It's still possible. The neutral rate can go down if the Fed succeeds in curbing inflation, and if they over-influence it, so it goes well below 2%, right? Well, in that environment, the neutral rate would have to come down. And if the neutral rate came down, you'd also have the inflation down. So let's say the neutral rate came down to 1.5%, and inflation came to 1.5%, which, by the way, we don't want. A little bit of inflation is good. But now we have 1.5 plus 1.5 is 3%. And most likely, the spread between the 10-year fixed and the 30-year mortgage would compress more towards its historical average at 2%. And that would give us a 5% interest rate. And so as you start to know the components, and you can then understand the role that inflation plays and how the Fed has to manage the neutral rate, you can start to better predict where interest rates will be in a very simple way. And so I really like this. I put a link to the newsletter, which I believe is not behind a firewall, in the notes below. I did a LinkedIn post on this where I did my best to summarize and explain what I just covered. And I also put a link, and by the way, I put the formula in clear, writing so you can clearly see it. And I put a link to the Calculated Risk newsletter. So there you go. Really interesting. I hope this helps. It helps me a lot. I mean, it makes me have better confidence when I talk about interest rates because I'm a loan officer, right? I'm no financial analyst. I'm no economist. But this makes plenty of sense, and I can completely understand it. And then I can kind of benchmark if rates go lower, why? What happened? Is the neutral rate lower? Is the direction of inflation perceived to be lower? Did the spread between the 10-year Treasury and 30-year mortgage compress? And I can understand it, and as I can understand it, I can better predict where interest rates are headed. And if whether I'm right or wrong, at least my opinion is anchored in some sort of basis, some sort of data, some sort of formula. And I like that. I like that a lot. And I hope you like it. I hope you found this helpful. I hope you're having a great week. We got one more day this month. Tomorrow's Halloween. Crazy. All I know is I can't wait for this election to be over. I hope you have a great day. I look forward to talking to you again soon. Thanks. Bye.